Okay, so it is my privilege today to talk to you guys about financial evolution. Okay, but as I talk about evolution, and thanks for the intro, it really saved me a lot of time from having to do my introduction here. Who here has that new? I'm not an iPhone user, okay, but who here has a Note 11, the new one? Is it 11 with the 3 cameras? Who has that already? Okay. Who here has already upgraded their phones? Upgrade a phone, or do you have a 2000 year phone? Who here has upgraded a phone? Everyone has, right? Okay, I'm gonna need some participation here, okay? So everybody wants to get updated with technology. Everybody wants to update their home. Everybody wants to update, everything else, all the material things that are replaceable. You are not replaceable. Therefore, you need to understand the evolution and the upgrade of life insurance too, okay? Life insurance, there's a lot of people who here have actually has gone to an appointment or talked to somebody, and somebody said, oh, I already have life insurance. And then you come to find out they really don't. They have car insurance, okay? Or they say, oh, I have life insurance, but I don't know what kind I have. Who here has that? Okay, so this is gonna be the time where you'll be able to explain. If you could get in and just let them know. I've been coming across a lot of people that have been saying that, and then I ask them, well, the first question I ask is, when was the last time you revisited your plan, and when was the last time your agent actually revisited your plan with you? 9 out of 10 times, people are gonna say, never. And a lot of times they're going to say, well, I got it with my car insurance because they gave me a discount. And then come and find out they only have a $5,000, $10,000 plan, right? So whose benefit did that agent really help, them or the agent? The agent, because why? They probably work on quotas and stuff like that. So, and please forgive me, I do have allergies today. Okay, so what I'm going to talk to you guys about, if I get this to work. Second. Next. Okay, so I'm going to talk to you guys about cost of insurance. Everything has a cost of insurance to all plans. Okay, there's 3 things here I want you guys to understand. I need you guys to take notes on all of this. Okay, number 1, cost of insurance always increases. We can't beat time. Okay, it's just like inflation. Our age is also inflation. Okay, the older we get, the more expensive cost insurance gets. Okay, all insurance is term, which means all insurance has an expiration date. And I'm going to go into this in more detail. But for a permanent policy, what year does it should go up to? 120. So 120 is a term, but of course we term it as permanent because nobody lives till age 120, right? Well, maybe someone in the world, yeah. 1 out of, what, multi-billion. No such thing as free insurance. And that's my favorite one because there are a few people that I come across, oh, I have free insurance. Oh, I pay 2 more years and I have free insurance. Well, wonderful, like my husband says. Well, let me tell you about this whole free insurance that you think you have, okay? So, next. Okay, so the first one I'm going to talk about is term life. Okay, who here knows what term life is? Okay, for those who don't, let me just share with you. Term life, go back. Okay, so term life is temporary coverage. Either you have a term period between 5 to 30 years. If you have a term policy, some people have a very cheap term policy, let's say for a 5-year, or no, we're going to go to 30 years. It's cheap now, expensive later, and there's no cash value to it. I'm not saying term is bad, because I do help families with a term. And on top of all my plans, I also have a term. So I do like term too, if it's suitable for that person, okay? For example, so let's say that, maybe I should come closer. Okay. Next. Okay, so let's say at 30 years, let's say I'm 30 years old, okay? And I have a 30-year term life for $500,000, okay? Next. You could, next for, okay. So at 30 years, it's very cheap for $500,000, okay? And It expires 30 years later, which is when I'm age 60. Does that make sense? So in the period between 30 to 60 years, if I do not pass away, let's reverse that. If I pass away between that 30-year period, my family and my beneficiaries will receive $500,000. Does that make sense? But what happens if you outlive 30 years? Either your policy lapses or eventually the premium is going to actually go very expensive. I've actually had a client that had a $500,000 term, and he was actually paying only $90 a month. And I told him 10 years ago, I really think that you should get a 20 or at least a 30 because you're going to outlive 10 really fast. And he goes, no, 10 is good enough. So 10 years passed on his anniversary, he's been disregarding mail. And a lot of people disregard mail received, okay? You probably do too, some of you, okay? So he disregarded the mail that he got from the company. And then on that 10th year anniversary, he was wondering, why did my premium jump up to $837? And I had to backtrack. And we backtracked. And then I said, you received a letter 3 months prior letting you know that your premium's jumping up or to cancel your policy. So this has happened. It also happened to JJ recently, to one of her clients. But this is what a term is. So I'm not saying term is bad, but you got to understand what a term is, and you need to explain to your client what the term is because the option is there, okay? The second type of policy out there is a whole life, okay? For my clients that say, oh, I have a free insurance, for some reason, they also have the whole life. And I'm not saying whole life is bad because we also help families. One of the product providers, we also provide whole life plans through what? A final expense plan, okay? But understand with a whole life, it is permanent with cash value. It has the fixed interest crediting, which is about 2 to 4%, sometimes 6%, okay? So like it says, pay your whole life. You're going to pay your whole life one way or the other if you stop making premium. And cost of insurance is deducted from the cash value. So for example, if your client has a policy and it says whole life, read it very carefully. If it says paid up whole life 10, or is it paid up 10 years whole life, paid up 20 years whole life? So what happens is the client actually pays for that long of a period and then stops paying premium. But the cost of insurance is going to get deducted from somewhere. And guess where it's going to be deducted from? The cash value. So eventually the cash value is going to deplete. The reason why I know about this is because my mom actually had a whole life policy for me ever since I was 4 years old. So when I graduated, she thought that I was going to have some kind of college funding. So when I was finally able to withdraw at 19, I only had $1,101. I always remember 1101. But that's what a whole life is, okay? The third one we have is variable life, okay? With a variable life, it is also permanent, a permanent cash value with interest crediting that follows the market. So if the market goes up really high, your cash value will increase that high interest credit. But guess what? If market goes down, guess where your cash value goes to the second year? It goes down. So let's say if you lost 50% of your cash value in your funding, how much percentage do you need the next year to recap that? You need 100%. When has the market ever done 100%? Never. So this one is very, very risky. And just for those who's about to take their license, FYI, the variable life, anything that says variable, you need your security license to do variable products, okay? So that's variable life. The next one is universal life, okay? With universal life, it is also a permanent policy plus cash value. Its interest crediting is roughly between like 4 to 6% cap and a 2% floor. So if market goes up very high, you're only going to cap at 4%. But if market crashes, you're going to get a 2% minimum. Does that make sense? So the fluctuation in between is very limited. But for those who want to understand the comparison, refer back to the Rule 72 for the whole life, the variable, and the universal life. And look at your policy and see what you have, because you got to understand, if you have 4% in something, 72 divided by 4 is 18, so every 18 years your money is going to double, okay? And then the last one is the index universal life. So please understand, universal life and index universal life are two different plans. The whole life, variable, universal, and index, the commonality for all four is that it is a permanent policy and it does have cash value. What sets it apart is the cost of insurance, the cap, and the floor. And variable, no cap and no floor. Make sense? You want to take a picture? Because I'm going next page. Okay, and I'm going to go into, I'm actually going to go into the index universal life. This is pretty easy, right? So you have to understand the differences. This is very, very important because when your clients, I'm going to tell you, some of my clients has one or the other. And if their policy is still very good, I would tell them leave it alone. Leave it alone, pay your minimal, but let me tell you what I got. So there are some clients that actually keep their previous one because they've had it for, maybe they haven't hit the surrender period yet, but they'll implement or supplement an extra policy, which is the IUL, okay? And with the IUL, if you don't know, get with your business director, but we have many companies that actually offer the IUL, but again, what sets it apart is also the cap and the floor, okay? So I'm gonna go over the IUL real quick. Remember this, guys? Okay. Okay, so there's two components here with the cash value. And the first one is the cash value. And also the second one is life insurance. So I'm gonna go back to the 500,000. Okay, I need you guys to draw this because this is actually one of our flagship products, okay? Number one, you pay a premium, a monthly premium. And please, if you help a family with $50, don't tell the next family that I could get you a policy for $50, because that's not necessarily true. Because if you're 20 years old and you're 55, you're not going to get the same coverage at $50. Do it right. Do it F&A and do their financial need analysis correctly and show them where they stand. People will appreciate when you actually map out their financials so that they could plan out. So you could plan out and see what the discretionary is, and then you can actually put them in a plan, okay? So when you pay a premium, part of that premium goes into cost of insurance. Well, some clients want to know, well, how much is going to go into here? How much is going to go into there? We don't know yet until after approval, because based on your medical history, if you have to do lab work, everything is based on medical history, your age, all that, okay? So just explain to your client that everything will be broken down in the binder, okay? Part of it goes into the cost of insurance. The second part goes into the cash value. And the cash value is actually mirrored in the S&P 500. And this is the National Life Group policy, okay? Every company is different. So with NLG, there's a cap and there's also a floor. Does anyone know what the cap is right now with NLG? 9.5. It depends, yeah. Absolutely. But so I left it blank, cap and floor, okay? So what it is, if you look down here, let's say first year, market goes up 10%, second year, market drops at 5%, but it's still positive, okay? Third year goes negative 10, and the market comes back up the fourth year, okay? With you being here, let me see. The first year, market goes up 10, you're also gonna participate on that max, the cap, okay? Market drops 5%, but it's not negative. It drops 5%. Your cash value in the second year goes up 5% more. Does that make sense? Market drops negative 10. So guess what? Your cash value in your policy, it plateaus until market comes back up. Do you see? So while the market is playing around right here, your cash value is secure and you're always gaining. Does that make sense? So you got to use this visual. It's very good when you use that visual. Some people are visual learners like me, but it makes sense when people see that visual, okay? So here, two things that could happen to you. One, if you die too soon, you know your family's going to have $500,000 death benefit. Is that right? Okay. And if you design, there's different ways you could design it where your family could get $500,000 plus cash value too, tax-free. Okay. But if you live too long, what does your family need? They need money, right? Who here has an uncle, an aunt, a grandparent, parents who should have been retired, but they still work? Why do they still work? I don't want to live that way, and I don't want to show that way. I want to be able to work at 65 because I want to, not because I have to. Does that make sense? And I want my kids to be able to learn that and to learn how to be disciplined. And I want to teach my families that I'm able to educate about this, that they could do the same thing too. Because in time, if you live too long, the money that grows in your cash value, you have your tax advantages in the policy as well. Does that make sense? Okay, so the reason why I love the IUL is because the IUL, if you design it correctly and accordingly, and you do your year-to-year annual reviews for your client, you're going to see that in its cash value, the cash value itself, you could actually use it for retirement. You can use it for emergencies. You can use it for college education. My youngest clients are 1 month old. As long as the 1 month old has a social security number, then they could actually get an IUL. Okay, so you could plan that out. Another thing about a National Life Group IUL, they actually accept clients who only has a TIN number as well. Okay, and so with this policy right now, between now and then, if something happens to you in between, you also have your living benefits as well. Isn't that amazing? So when you, oh, I'm not going to go into that, sorry. So with the living benefits, I mean, get your brochure, do your homework, go on the website, understand about the living benefits. You got your terminal illness, your chronic illness, critical illness, and critical injury. Okay, and I know that there's some updates with the IUL. I know that I was reading on the updates yesterday, and it stated that with the chronic, you know, there was a 2-year waiting period. When it updates, it's only going to be 30 days waiting period for chronic. So this is upgrading. This is awesome, guys. So just like your iPhone, update your plan. If you don't have a plan, sit down with your business director and plan out together, because this is the future and you guys want to be protected 100% for your family. Okay? So that's all I got to share. Thank you so much.